Zero DTE options trades can be super powerful, and it pays to know how to trade them. In this video, we'll give you a quick overview if you're new to them, and then dive deeper and show you a specific strategy for trading zero DTE options that can turn an initial losing trade into a winner. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree this is the top YouTube channel to help you grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And many of the traders on our desk are trained to trade in a daily time frame. And so naturally, option strategies that have a one-day trade duration are of particular interest to trained professional options traders. And so there's a world of option strategies that are broadly categorized as options income trades. And these strategies can be implemented over any time frame. Some options income strategies can be initiated and concluded in a single day, and others can last for months. What we'll be teaching you today is a one-day trade, what's called a zero DTE trade, which stands for 0 days until expiration, meaning that the options contracts we'll be trading will expire on the very same day that we're initiating the trades. And so there are 3 great things about zero DTE trades that make them particularly attractive to day traders. And first of all, unlike with swing trades or even outright investing in stocks, the result of the zero DTE trade is known that day because the options expire the same day that the trade is entered into. And so by the end of the day, you'll know the final value of each option. Second of all, the trader has 0 overnight risk for the obvious reason that the trade expires the day it's entered into. And so you aren't exposed to huge international events, overnight earning surprises, bank failures, and all the other stuff that keeps traders literally up at night. And finally, unlike in the old days when there were options expirations only once per month, believe it or not, indexes like the S&P 500 index, known as the SPX index, or the NASDAQ 100, known as the NDX, both of those have expirations every single trading day, so that basically you can execute this strategy repeatedly, day after day, 250 times a year if you want, instead of like the old days where you only had 12 bites at the apple a year. And so today we're going to be going over one very simple zero DTE strategy. Now, in order to explain how this strategy works, we need to make sure that everyone watching this video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy. And so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index didn't close above 40.75. So the call seller just pockets the premium, and the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market did not close below the 4,000 strike price. With that in mind, let's head back to April 28th, Friday of last week. And as you can see, the SPX index opened that day at 41.29. And so let's say that around 10 a.m. that day, we pulled up the options chain expiring that day, and we picked the options that are closest to the money, the 41.40s, and we sell 5 of both the 4140 calls and the 4140 puts expiring that day. And then for protection, we move up 30 points to the 4170s and buy 5 of those calls, and move down to the 4110s and buy 5 of those puts. And so when an options trader sells a call and a put option at the same strike in the same expiration and buys a protective call and put options equidistant from each other above and below the short options respectively, that formation is what is known as an iron butterfly strategy. And it's one of the many option strategies that can be implemented in a 0 DTE, a one-day time frame. Okay, so now let's analyze the cash flow of this transaction, because it's very important to understand how we're going to manage this trade. And so first off, we receive a price of $6.90 for the 5 calls we sold at 41.40. And remember, index options pay off $100 per point that the market moves past its strike price. So you multiply that by 100, and we sold 5 of them. So the total premium we collected for the short calls was $3,450. The short puts, using that same calculation, brought in $5,450. And then for protection, we had to pay out $265 and $1,060 respectively. And so when you net it all down, there's a cash inflow, positive cash flow on the trade of $7,575, which comes right into your account, and your broker will require you to have at least $7,425 in your account to make this trade in the first place. So where do we go from here? Well, let's do a little bit of calculating to understand where we might take action. Well, we executed 5 options at each of the 4 strike prices that we showed you, right? And so if we had only executed 1 option at each strike, we would have brought in 1/5 of the amount of the credit, or $1,515, as you can see, right? Well, remember, those calls we sold and those puts we sold, we're obligated to pay $100 per option for each point the market goes past the strike price of those options. So for instance, the market moves up $15.15 points up to 41.5515, then each of the calls were sold are obligated to pay out $1,515. And the same for the puts on the downside. Those are obligated to pay $1,515 if the index closes at 41.2485 for the same reason. And so many options traders would at that point take action to protect the position so that we don't lose money on the trade. This is all going to become a little clear when we show you what happens next. And that is, as you can see, the SPX index went up almost exactly to our upside adjustment point at 41.5515. And so it's time for action. And the specific action we would take in this case is to execute what's called a call butterfly roll, which in this case involves buying back all of the 4140 calls, selling 10 of the 4170 calls, turning a 5-lot long position into a 5-lot short call position, and then buying calls further points up, 5 long call options up at 4,200. And so by the end of the roll, the position looks like this, where there is no position at 4140 that got bought back, but there's a new 5-lot short call position at 4170, as we mentioned, because we sold 5 more of those than we had long originally. So the position actually becomes a short call position. And then, of course, we have the new long position up at 4,200. And so the put side hasn't moved at all, but we did move the call side up to those 2 strikes. And so this new position is called by options traders an iron condor, because the short calls are now above the short puts, whereas in the butterfly formation, they were at the same 4140 strike on both the call and put sides. And so keeping score of the cash flow after that butterfly roll, you can see from this calculation that after paying for the 4140 calls to close them, selling 10 of the 4170 calls to open up that new 5-lot short position, and buying those cheap 4200 calls for protection, you can see that when you crunch all the numbers, the roll had a cost to it, and we ended up having to spend more than half of our initial cash flow on that roll, bringing the positive cash flow down to $3,315. Okay, so at this point now, let's move to the end of the day so that we can calculate the final results of the trade, because remember, these options are 0 DTE, so they stop trading at 4 p.m. Eastern Time. And as you can see, the index closed at around 41.6948, just pennies below the 41.70 call strike that we had rolled to. And so now we can calculate the results of the trade, which is pretty easy because as it turns out, all of the options expired worthless. Why do I say that? Well, both of the calls, the short 4170 and the long 4200 calls, both expired above the SPX closing price of 41.6948. So those have no value because calls only pay off if the index closes above their strike prices. And for the exact opposite reason, because the index closed way above the put strike prices of 41.40 and 41.10, those also expire worthless, causing both of the puts to expire worthless because they don't pay off unless the index closes below their strike prices, resulting in all four options expiring worthless, which is actually really good news for this trade. Why? Because then that cash flow that we kept after the butterfly roll, well, we just get to pocket that as our profit, which turns out to constitute a 44% return on our original capital in the trade in just one day. And so what I'd like you to take away from today's video is the fact that there are techniques for trading options that can work beautifully within the one-day time frame of most day traders. And the best part is that you don't need to pick a direction for the market that day. You can simply enter into a butterfly trade like we did in this case, and then adjust the trade as the market tells us where it's going to go that day instead of us predicting it. And in many cases, we can take home a solid profit within that one-day time frame. Pro traders are aware of these kinds of zero DTE strategies and use them all the time. And now you have an idea of how you might be able to incorporate these ideas into your personal trading.
Okay, we hope you enjoyed this video, but we have more for you. Click on the video appearing on your screen right now if you want to learn the secret to faster cash flow from the covered call option strategy.